This is the current federal tax developments for the week of November the 17th, 2025. Current federal tax developments are brought to you by your state society of CPAs. Now, this week we're going to talk just about a few things that went on. First, I'm going to talk about the annual adjustments to the retirement plan limitations. This came out a bit late this year, most likely due to delays caused by the government shutdown. So we'll talk about what adjustments we see on those retirement plan numbers. We also have the IRS releasing information about steps that can be taken to ensure investment trust status for digital asset staking entities. We'll talk about penalties on microcaptive transactions. We'll have a little discussion court case there. Also, we'll talk about a second court of appeals refuse to overturn a tax court decision looking at ownership requirements for non-business theft losses in the case of a Madoff-related situation. And finally, we're going to take a look at a case that defines the scope of net operating loss carryback waivers, looking at the question about whether you could elect to carry forward one only, so waive the carryback on one type, but you qualified for another type, and for that particular loss, you could go ahead and say, well, I'm going to go ahead and let that go back. So we'll take a look at that decision. But first, let's talk about the delayed, but nevertheless out now, annual adjustments to retirement plan limitations. This is found in Notice 2025-67, came out November the 13th of 2025. As you know, every year we adjust annually limitations for various retirement plan numbers. This year, we're going to take a look at these cost living adjustments that are effective January 1st of 2026. And these apply basically to qualified retirement plans, individual retirement arrangements, and a few other employee benefits. These adjustments are mandated by statute. Code 415D requires them to be accounting for cost of living increases. And it is an important bit of guidance because these are going to be the compliance thresholds and maximum contribution levels for the rapidly upcoming next plan year. So we need to be ready to start on that. Let's talk about some of the limitations and what they changed to. The annual limitation on the defined benefit that you can fund toward under Section 415 B1A, it went up from $280,000 for 25 to $290,000 for 2026. The annual contribution limits for defined contribution plans, which probably more of you are interested in, under 415 C1A, that increased from $70,000 to $72,000. The annual compensation limitation, which is how much of the compensation, when we're talking about allocating a contribution based on qualified or covered compensation, how high can we go with that? Threshold came in a number of years ago, and Section 401A17 increased that threshold from $350,000 to $360,000. The key employee threshold for top-heavy plans under Section 416A1A little I, that increased from $230,000 to $235,000 next year. And this compensation threshold defines a highly compensated employee. That one under 414 Q1B, that number didn't move. That remains at $160,000 for next year. Now, the elective deferral limit. This is under 402G1 and 457E15. Generally, most people think about this as the amount you can defer to a 401k, ignoring catch-up contributions. That number is going up by $1,000 next year. It increased from $23,500 to $24,500. The age 50 and above catch-up amount, ignoring the special boosted catch-up. We know we have that in there too, but this just sets the base, and then the boosted catch-up runs off the base. So this is set under Section 414 V2BI, and it does not include simple or 401k 11 plans. Those are basically the simple 401k plans. That increases from $7,500 to $8,000. Those simple 401k plans use a simple limit. And that simple limit for the 50-plus catch-up is under 414 V2BII. That goes from $3,500 to $4,000. Now, the Roth catch-up threshold, this is the one now, remember, if you have what are considered to be, and it will be under the regs. Well, we don't know what the regs are this year. You have to use a measuring. But if the employee had earned from that employer in the prior year more than $145,000, more than $145,000 on their 2025 W-2, that was going to be the limit. Now that's going to go to $150,000 for 26. Now, that limitation dealt with the issue of, whether or not you have to put the money into a Roth, basically a deemed Roth account. And remember, people who individuals that don't want to say highly compensated because that's already taken as a term, but individuals that are upper income, shall we say, at least per their employment, upper income with that employer, they cannot do a catch-up contribution to a traditional 401k account. It must go to a designated Roth account in the plan. We discussed the final regs on that a couple weeks back that came out, and also remind you at that point about the fact that plans have certain options regarding how they're going to deal with that this year. But a plan has to, if they're going to allow people that make more than these limits to make catch-up contributions, they're going to have to put in basically a designated Roth option into their 401ks and allow everybody doing catch-up, if they want to do designated Roth. So that's involved. Then on IRA issues, we have a few issues there that come up. The general IRA deductible amount for 2026 under Section 219B5A is going to increase from $7,000 to $7,500. The age 50 and higher catch-up amount, that's going to go from $1,000 to $1,100. So somebody 50 or above in 26 could defer $8,600, while this year for 2025, the amount of deferral would be capped at $8,000. So basically for that person over 50, we're looking at a $600 increase. For those under 50, we're looking at a $500 increase. How about qualified charitable distributions? Well, they're going to increase from $108,000 this year for 25 to $111,000 next year. Remember, you must be over 70 and a half, and that one is at the time you make the contribution. It has nothing to do with the RMD, trigger, although it can count as RMDs, which, gets us into that. But they didn't link it with, so the RMDs are going up. This isn't. You can make the direct transfers from your IRA to the charity, which has the advantage of not raising your adjusted gross income and not requiring you to burn any of your standard deduction and still get a charitable contribution. So it's a useful tool, assuming that you have the funds in an IRA to enable you to do it, and you normally are going to make that contribution anyway. Roth IRA contribution phase-out range for a married filing joint taxpayer. We also have in the written materials limitations for single and head of household. But for married filing joint, that's going to kick up to $242,000, $252,000. That's up from $206,000, $236,000, right, to $246,000. So basically, we're going up by, in essence, $6,000 this year in the phase-out range. And again, that's combined income for the married couple. And as you're probably also aware, that also becomes the limitation when you're considered covered by an IRA. But that's a whole different set of issues. So again, all of that is now available. You can go get it. We do have the link to it in our article on the Current Federal Tax Development's website. Also in the materials the PDF we put out, every week with one of these that you can find on the currentfederaltaxdevelopments.com website. If you click to our audio and video materials, we have it there. Next up, we have an enrollment procedure 2025-31 issued on the 10th of November that is going to deal with a little bit of a problem about if you have a trust you want to be an investment trust. How does it handle digital asset staking entities if it wants to be involved in that? So this is a safe harbor saying if you do this, we're going to consider this to meet the safe harbor for the trust and be able to be treated as an investment trust. Now, this provides a safe harbor if a trust engaged in digital asset staking to maintain two crucial classifications. Classification number one is an investment trust status under Section 301-7701-4C. And secondly, a grantor trust status for federal income tax purposes. The risk involved is whether staking constitutes a business or grants the trust a prohibited power to vary the investment. both of which would be considered to be problematical. Assuming you want grantor trust or investment trust status, you'd prefer not to have that. And given the tax rates on trust standing alone, you would probably prefer to avoid classification where you're going to be taxed at the trust level. Now, this applies exclusively to digital assets on a permissionless network using a proof of stake consensus mechanism. And for those who aren't aware, whenever we're going to talk about, especially we're talking about, cryptocurrency, original Bitcoin used, and so did everything else initially, used what was called a proof of work concept. One of the issues, and we're not going to try to go too deep in the mechanics of how how basically the ledger works in the case of these cryptocurrencies, so that we, basically aren't going to get too deep into all that technical stuff. But generally, the catch becomes we have to update the ledger. Remember, the ledger, the blockchain, it shows us basically who owns which units of Bitcoin at this point in time, or any, various other issues, whatever other things involved. Well, because there's no centralized repository, there's not somebody like Chase, sitting at the top who centralizes and, is paid to process this directly, but rather we have a decentralized system for this. We had to come up with a way to pay people to participate in a decentralized system, because otherwise it's something that's going to take a bit of work, and it creates a lot of problems. Now, what proof of work was meant to be was that over time, so to get people to post the ledger, to update the ledger, and once they've done an update, then basically the entire group involved in that process, is then allowed to say, yeah, they got it right, no, they got it wrong. But to be able to be the one that does it and the one who's going to be paid, you have to, in proof of work, be the first party to solve a rather messy and complex mathematical problem, which gets consistently tougher, as the number of Bitcoin outstanding grew. It meant to make sure that the number of Bitcoin in circulation didn't grow out of control. So it couldn't be too simple, right? It's going to take some time and some work. And, basically, it wasn't just going to be kind of randomly assigned. Well, because of that, great, except it turns out that the problems to solve have become so hard now that it takes an immense amount of computing power to solve those, which tends to reduce the number of organizations that might be willing to be part of this. Because honestly, there are parts of the country you would not want to try to do proof of work generally here in the Phoenix area, because all of the computing power you need is going to generate insane amount of heat. And it's not really going to work well in Phoenix because we have insane amounts of heat before we even start worrying about this. So trying to keep those servers cool enough, those processing units cool enough so they keep working, and also so anybody can be in the same building with them, it's going to cost more than the Bitcoin you're going to get if you actually get it right. Or I should say, the Bitcoin you'll get on the occasions, which will not be all of them, that you get control, will not be enough to pay for the amount of power being consumed to run those processors and to keep them cool. Here in Phoenix, be very difficult. You're generally looking for cooler locations with a lot of hydroelectric power, lower cost power, and not as much work to keep them cool. Well, that became a problem. So what happened was they pulled back, and for certain coins now, we now use a concept called proof of stake. Proof of stake is when you pledge so many of that coin into a pool. And everybody who pledges essentially has the possibility of being drawn to be the one to update the blockchain. And again, there'll be the same voting mechanism. And the reason why you're putting coins up is because if you try to cheat and the blockchain votes against you, or those members of the group that can update the blockchain vote against you, then you risk losing your stake. So therefore, you don't want to get it wrong. You want to make sure it's right. That's called proof of stake. The question, though, becomes now, what is that really? Is it going to be that? And do we have problems with powers to vary the investment? And is that a business that we're running? Now, because proof of work was pretty clearly a business, but proof of stake seems much more passive, especially as many times what you do is you get a group to grow together, right? You're put into a pool that then is going to be the staked group in order to then solve every so often. That helps improve your chances of being drawn. Now, generally, an entity is classified as a trust if its purpose is to protect or conserve property for beneficiaries, not to conduct a business for profit. And a key requirement for investment trusts generally is that there must be no power under the trust agreement to vary the investments of the certificate holders. Again, you're merely there to protect or conserve property. You're not there to actually operate a business. A power to vary is a managerial power enabling the trust to take advantage of market variations to improve investments. This came from the case of Commissioner versus North American Bond Trust. If the trust possesses broad powers, so it maybe has the power to buy and sell real estate, borrowing money, it's classified as a business association, which will convert it into either a corporation or partnership for federal tax purposes, but not a trust. Obviously, we would prefer basically, not being classified as corporation or partnership, rather either being an investment partnership or a grantor trust, either one of which is going to let that stuff flow directly and without having to do anything fancier involved. Now, safe harbor requirements. The staking activity must align with the purpose of protecting and serving property. So, first rule for your safe harbor: the trust may only own cash and units of a single type of a digital asset. So that's step one. To meet the safe harbor, there's your first step. Secondly, the staking must primarily serve to protect and conserve trust property by mitigating the risk of external property controlling staked assets. And the indemnification of the trust digital assets must be indemnified from slashing penalties resulting from staking providers' activities supporting the conservation purpose. So there's protection there. And the trust or sponsor must be unrelated to the staking provider, and staking rewards must be allocated based on arm's length arrangement. So basically, these are the categories of: you have asset protection, you have a purpose of staking and protecting assets with staking. You get the indemnification rights from slashing penalties, those penalties that say, yeah, hey, you guys played fast and loose. You're losing, some of the staked assets. If you're a staking provider, those people that are like pooling the assets together, you know, if they kind of go off the deep end, and you also can't be related to the staking provider, and staking rewards to be allocated based on arm's length. So we're both looking at arm's length transactions. Is what we're doing. Also, we must have certain management and liquidity requirements. The trust agreement must specifically prohibit the trust from seeking to take advantage of market variations based on the value of digital assets or staking rewards. Also, custody. A custodian must hold digital assets and private key. And only the custodian may access the keys to effect sales or transfers. For liquidity management, the trust must maintain written liquidity risk policies compliant with national security exchange rules, must have liquidity reserve, must stake less than all assets to create a reserve based solely on factors related to meeting redemption requests. And rationale: the adherence to strict liquidity policies ensures management decisions are driven by fiduciary duties, conservation, and redemption, rather than market timing to maximize the profit. So if you're involved in that area, you probably want to go and consult this ruling. Next up, we have a case: Patel versus the IRS. This is Tax Court 165 TC number 10, reported tax court decision issued here in 2025. Now, the tax court addressed accuracy penalties following its rulings that payments to the captive, Plymouth and Magellan, and the reinsurers were not insurance premiums. That was a previous ruling. The primary penalty we're looking at here is under 6662A, attributable to disallowance of benefits due to a transaction lacking economic substance. This is a reported decision because we're going to look at whether there is like a first general test that a transaction must basically trip over to drop into the statutory penalties for transactions lacking economic substance under 77010, and then we apply the two steps in the statute. Now, the key failure they had here in their transaction is premium pricing was developed to target the maximum deductible amount allowed under Section 831B. It wasn't based on actuarial computations based on the types of liabilities they were seeking to insure. That is a problem. And it's really kind of interesting because those of us around defined benefit plans, especially back in the 80s, you all kind of knew that actuaries could take the number you wanted and come up with a rationale for it for funding. That was kind of like the traditional, because small defined benefit plans generally were looking to increase their contributions, right? Not really based on paying the benefit, you understand, but based on they just wanted a bigger pool, bigger deduction, and bigger thing growing tax free, which once it got close to overfunding the defined benefit plan, you then magically terminate the defined benefit plan, paid out and rolled everything into a defined contribution plan where everybody had their own account balance and suddenly it could grow as much as it wanted. Yeah, that was the defined benefit world of the basically the 80s and the early part of the 90s. It's still that theory still kind of works today, but it's tougher, to make everything work. And what helped it, or weirdly helped it then, was the fact that interest rates were so ridiculously high, especially in the 80s. I realize interest rates, you consider them high today, especially if you weren't around for the 80s, because these are the highest you've ever seen. But believe me, in the late 70s and early 80s, we have interest rates that blew what you see today totally away. It's just kind of the way it worked. Now, this arrangement in question involved a circular flow of funds. That's the way these microcaptives tend to get in trouble. That went to the capstone risk pool, which was the way they claimed they diversified out their risk by they had a bunch of these get together in this pool. But the problem was that traditionally, they wanted structures so whatever they put in there as premiums will come back to them as distributions from the pool, in order to pay back the quote earnings out of it. So the practical matter is almost everything they put in came back except for the amount that was kept by the promoter who was putting together that centralized, supposedly independent insurer that was doing it. And in this case, it was also interesting because even though we had supposedly insured all these things via our captive, the taxpayer in question maintained commercial insurance coverage for many of the same risk, which kind of got the whole point of why do we need the captives? You're paying for tons of insurance, from for these same risks from traditional insurance companies. And the taxpayer in this case tried to say, well, he didn't trust them. But then, of course, we don't trust them. Why are you paying them anything? If you're going to just self-insure this risk, why wouldn't you self-insure this risk? If you really believe that the insurance companies would never pay off, then kind of no point in paying them, right? So that kind of went against the rationale. So in any event, what they found was that this was just put money in here, call them insurance premiums, get a deduction for the corporation, have them go to their controlled microcaptive, have that microcaptive then send a bunch of those premiums to this reinsurance pool to make it look like they were distributing risk over a wide pool. That reinsurance pool was structured in such a way, though, that effectively it was pretty much just sending the exact same dollars back to the parties that put them in, that paid for reinsurance. So, yeah, it's just saying this is just a mere, you're going to put in, let's say, $500,000. And all it's going to happen is $500,000 is just going to go round and round, come right back into the controlled microcaptive as earnings, and bingo, perfect world. Because there are special treatments there that eliminate taxes paid internally, plus they don't pay tax on the premium. I mean, it's like a perfect world if it works. In this case, the court ruled it did. Now, the threshold relevancy test is what's coming into play here. The court confirmed under 77010, before you apply the two-part economic substance test found in that section, you must clear a relevancy determination, right? The relevancy determination, must be made using common law standards because the section tells you it doesn't apply. It applies to transactions that meet the traditional, lack of economic substance, tests that were developed by the courts. And we had a case that had said earlier, in district court that's on appeal. What had been ruled was that, well, realistically, there's only those two tests. Those two tests are the old tests the courts had, so there is no threshold determination. First, that you would have been in trouble under the old economic substance test to get this thrown out. Rather, we just go straight to the two-part test, and if you meet those two parts, then you're bad, and you're going to face this penalty. Now, the tax court unanimously disagreed with that tax court ruling in the case of Liberty Global. They said no relevancy test required. And this case is currently before the Court of Appeals, right? So it's a Court of Appeals case, I believe, for the 10th Circuit right now. But the tax court leaned in, and the tax court, as unanimously said, nope, district court got it wrong. Now, that could have quite a bit of influence because district courts don't hear tax cases regularly. I mean, they hear them, they can, but it's not as if that's what makes up a judge's, almost the entirety of the cases load they're hearing during the hearing. In fact, usually makes up a very small part of it. So quite often the district court, the tax court sees these things every day, and the Court of Appeals also sees more tax stuff. And generally, there's always the problem when you have a district court case, is that really going to stand up on appeal? If it's appeal. So what the tax court said, citing the Malone and Hyde cases, the court confirmed the economic substance doctrine is clearly relevant in cases. Okay, here's the catch. So they ruled that, because those actually get just telling us we did clear the first test anyway. So they ruled that there are two separate. We have to clear the first test. Is this really, is the economic substance test relevant in a case like this? And then number two, we do the two-part test. Now, the court said, hey, taxpayer, you're right. We have to have a threshold test here. But then taxpayer, bad news. Your transaction meets the threshold test. Therefore, we go on to the two-step. So while you won, you didn't gain anything, except maybe somebody in the future could gain off the case where theoretically they meet the they don't meet the threshold test, but they would have met the mechanical test. Now, that is probably a more theoretical case. There are situations you can dig up where it would work, but I'm saying in many cases, you're just going to find, which is kind of what the district court found, that, the court said it has yet to figure out how to conceive of a situation where it could meet these two mechanical tests internally, but not clear the threshold test. What it really allows them to do, though, is argue over whether prior to this law, basically the economic substance test would have applied under the old court-developed theory of economic substance. You could use case law from that to prove it would or wouldn't. Now, the court also rejected the Patel's argument that the structure was congressionally induced because the payments were found not to be bona fide insurance premiums. They said, yeah, Congress said you have microcaptive. That's not your problem. Your problem is how you decided to work with it. Right? You didn't compute insurance premiums. What you did had nothing to do with insurance premiums. So while Congress said, and there's no problem with this, if you're actually doing, basically captives and you are actually using them for insurance purposes and you meet the microcaptive size, you're going to get the tax treatment. But it's got to be real insurance. They didn't just say you can throw money out there and, we'll just call it insurance. They also didn't say that, the actuary has to use actual actuarial principles and the contribution needs to be, which is what the tax court held in this case, needs to be the amount you derive is necessary to protect against the risk, looking at the actual risks, etc. You don't start by saying, well, I want exactly this much a contribution. Say, how do I make that work with the risk? And then you sit there and you brainstorm risks and magically get something that you then claim with stretching quite a bit. In this case, I would say, that it actually was for that insurance. As I said, they just kind of lost that side of it. Now, a transaction lacks economic substances, right? If it fails the objective or the subjective test, those are two ways they could do it. Now, the catch is when they do, this particular test, right? So what we have here is we have the objective test for failing economic substance is the transaction, failed because the transaction does not meaningfully change the Patel's, economic position from the tax effects. This is the two part. So now, after having decided, get myself back here straight, we had decided right away that under the old court-imposed economic substance test, this transaction was dead, right? It couldn't have cleared the old test. Now we got to look at, though, does it fail the economic substance test under the two-part test? And as I said, we have two ways we can fail. First, objectively, economic changes. In this case, the transaction did not meaningfully change the Patel's economic position apart from tax effects. If the only thing happening is, your economic, your return is derived from the tax benefit, that's considered to lack economic substance. This evidence indicated the circular flow of funds and grossly excessive premiums paid to the captive. They paid $4.5 million for this, what the captives were insuring, versus $100,000 for commercial to cover the same things. And they never had a claim that ever went to the captives, which kind of suggests it was highly unlikely that they needed that much of a premium to cover the risk. Okay. And also, there's a secondary subjective test, which, by the way, they also fail. In this case, they failed this test because the evidence overwhelmingly showed Dr. Patel orchestrated the captives to minimize their tax deductions. Was there a substantial purpose of essentially reducing killing taxes, missing kind of the other side of the arrangement? And this case says the emails confirmed the primary purpose was tax reduction. Premiums were set by Dr. Patel. Dr. Patel is a physician. He's not an actuary. That means he probably shouldn't set the premiums, but he was telling the actuaries the premiums he wanted. Okay. And he's set by him to hit the maximum deductible limits, not set by actuarial principles. As such, they said, well, everybody was instructed to hit this premium, right? They didn't really start with the risk being insured and calculate a reasonable sum to pay to insure that risk, which is the direction you've got to move. Now, the penalties were sustained and all defenses were rejected. There's increased penalty because they didn't disclose the transaction. So a 40% increased penalty was sustained for 2014 and 2015. They failed to disclose many critical facts, including the flow of funds to family members, the identities of the promoters, for example, CIC Services in this case, and the capstone pooling arrangement. All of those details were never disclosed to the service with the returns. They also had that negligence and substantial understatement penalties be sustained on alternative grounds in case they didn't get that one. And there's no reasonable cause defense. The reasonable cause defense and good faith defense, which are available here, were failed for two reasons. First, it does not apply to penalties tied to the codified economic substance doctrine. And so while it could have applied to the alternative grounds under negligence and substantial understatement, it can't apply here. So it can't apply to the 40% penalty because they'd failed to disclose the transaction. And secondly, this goes back to neonatology. You, Dr. Patel, the shareholder, the corporation could not reasonably rely on advisors who are deemed promoters of the transactions. If the party in question is a promoter, is out there actively promoting the transaction, you cannot rely on their advice to give you reasonable cause. As I would tell a client, they darn well better be right, because you're not going to have a chance to argue that, well, how would I have known? I'm not a tax expert. Because what the court's rule is, you should know that if somebody is profiting only if you participate in the transaction, you're only going to get paid if they give you the answer that the transaction is one that, qualifies for the tax benefit. Then you have to understand there is just a huge conflict of interest involved here because, again, they are likely to give you the answer that, sure, it qualifies. Somebody who truly has no skin in the game. You go to your attorney, you pay them, right? You go to a tax attorney, you pay them to research, you pay them to look into this in detail, you pay them to go through all the information, right? All of that stuff. In a complex situation like this, I would probably defer to a tax attorney who specializes in the area, to give me a ruling and an opinion, and not an attorney that's involved with the transaction. My client wants to do it. I want that opinion because that opinion is the one that could get me out. I'd probably also be telling the client, you better disclose this, because if it turns out they claim this economics, that you come under the, economic substance rules and you come under these penalties, if you haven't properly disclosed, you cannot get out of this. So we have a problem. The other reason I say go to the independent advisor is, look, that person is going to do it. You're spending this money, and they're going to give you the answer they derive. Now they know that you'd like a yes. They know about all those things, but they also know that if they say, hey, it's fine, and you get nailed and you get penalized, right? Because you told them, don't worry about disclosure. It's all fine. It's great. There's no problem. You're probably going to be communicating with the insurance carrier for that attorney regarding a malpractice claim, right? Regarding a claim, seeking damages from them for, the fact that you gave, that person gave you bum advice on this opinion you paid for. Okay. So that's where you go. Next up, Pascucci versus Commissioner. Now, this was a case decided by the tax court originally back in 2024. It was Tax Court Memo 2024-43. But this week it was affirmed by the United States Court of Appeals for the Second Circuit, case number 24-2429, that came out on November 12th. And this involves the Madoff situation, but with a twist. And the real problem here is going to be who owned the asset. Who owned the asset? There's no question that Bernie caused the loss here. But the question is whether or not it was a theft loss that they could claim on the individual returns, or if it was rather a loss inside of an investment vehicle that would only have serve the purpose of reducing the value of that vehicle. So here's the case. The case facts and deduction claim. There was an $8.2 million theft loss deduction claimed on the taxpayer's 2008 return. This loss stemmed from the decline in value of variable life insurance policies following exposure of the Madoff Ponzi scheme. As you probably are guessing right now, the variable life insurance policies were partially indirectly invested in with Bernie's group. They had investments there eventually that you find when you dug deep enough. Now the question becomes, can the policyholder of variable life insurance policy look through and say, hey, look, Bernie stole from me? and claim $82 million theft loss. The real question is not whether there was $8.2 million taken. Yeah, there was. But the question becomes, who was it stolen from? Okay. Now, the investment structure was the policyholder premiums were held in insurance companies' separate accounts, which invested in Tremont Limited Partnership. That limited partnership had part of its funds invested in Rye Broad, a feeder fund, which invested in Bernie Madoff, right? So basically the BLMIS, the Madoff funds, right? Madoff's own investment fund or investment plan. So basically Rye Broader, basically put their money into, with Bernie. Turned out not to be a great place to put your funds. The question becomes, though, no question, Bernie deceived everybody. No question, Bernie walked off with those funds in Rye Broad, the feeder fund. No question, that basically stole from there. No question that the investments obviously went down in value because there wasn't anything there, very little there in that case. So, I mean, all of that is true. So our problem now becomes, how in the world do we deal with that particular issue? Can we look through and say, hey, in this case, the taxpayers, the owners of this policy, they are the theft victims here. Now, the tax court analysis looks at legal and constructive ownership of those funds that went to Bernie. Okay. The private placement memorandum and legal title explicitly stated that the insurance company was the legal owner of the assets in the separate accounts. They have to be. You got that wrapper to allow you to treat it as an insurance policy, which, by the way, remember, gives you, inside of this, a tax deferral on this investment. Remember, whole life and other types of cash value life insurance policies. Some people tell me to use permanent is what the industry likes to call them. I say, no, most of them, they don't end up paying everything, so they end up surrendering it. So, no, it's not permanent. It's deferral. If you hold it until you die, then yeah. But by that theory, a term policy is permanent as long as you die during the term, which I wouldn't buy that either. So I'm going to say I just call them cash value policies. And there is a true investment component inside of that policy. And having insurance around it is what wraps it, the wrapper that allows us to not worry about having to pay tax on the dividends, the interest, capital gains, and all other stuff that goes on inside of that wrapper. Investment control doctrine. The taxpayer failed this doctrine. He did not have unfettered commands required for constructive ownership. He had no right to manage or influence investment selection. Note that if he had, it wouldn't have really likely qualified under the insurance category. So, he didn't have the right to go down and direct to that level. So the court said you couldn't meet the Madoff safe harbor under Revenue Proc 2009-20 because you were too far removed from the fraudulent arrangement to qualify as a qualified investor under the theft loss relief. And they noted it was theft of policy versus assets. The taxpayer owned the policy, and the policies weren't stolen. They were worth a whole lot less. They weren't stolen. By the way, whenever we get to theft and investment, this is often the problem. You need to have stolen from you. And quite often the problem is that, for instance, we talked about a case a couple weeks ago where they had purchased stock, in essence, on on statements from the seller that eventually the funds they had given them to buy the stock would be reinvested in, would go back in the company, basically directly or indirectly. And that didn't happen. And, as the court said, well, the problem was, there was no legal requirement for the money to go back into the corporation. It was supposed to go back in the corporation. Said, now we got this thing. Yes, somebody may have lied to you, but it wasn't theft because you still have the stock, and the stock was real stock in a company. Just the company didn't end up getting this extra investment that you thought was going to help it build its value. Same kind of problem here. So the policies were not stolen. The deduction must attach to the ownership of criminally appropriated property, funds stolen by Madoff. Madoff did not give Bernie's group the funds to buy investments. They rather transferred the funds to, the insurance company, which held it in a separate account, which then they were going to put the money in this limited partnership. The limited partnership made decisions where to invest, and they made a decision to put the money into Bernie. So they, in essence, the LP had a theft issue. But the problem is that theft issue is going to be inside the insurance wrapper. And now the wrapper is going to do double duty, and unfortunately not good. It's going to not only the wrapper is only going to keep you from having to pay tax on it, not only keep you from having to pay tax on the income, which is what we want, it's also going to insulate you from this loss flowing out anywhere, which we don't want. So bottom line, it's kind of bad. The tax court ruled against them. They went Second Circuit. This week, the Second Circuit said, nah, doesn't work. The Second Circuit emphasized the state law controls termination of taxpayers' legal property interests. The separate accounts held limited partner interest in Tremont. Under Delaware's revised Uniform Limited Partnership Act, a partner has no interest in specific limited liability property. The court cited its prior rulings in Madoff that limited partnership interests in feeder funds do not confer an ownership interest in the money invested in BLMIS, Bernie's group. And so the Second Circuit says, look, you can't even get past the first layer. Because as soon as as soon as the court looks at what entity owned the investment account where the theft took place, and it was a limited partnership. And as Second Circuit notes, even if they had owned limited partnership interests themselves personally, that wouldn't have been a theft from them. It would have been an issue with limited partnership. And since you have no interest inside, you couldn't take advantage of the safe harbor. Second Circuit says we don't have to get the whole question about the insurance policy and anything else. We just have to get to the fact that, it's not going to work because there's limited partnership that actually owned this interest, right? So they said, so the multi-layered corporate structure in Apple state laws meant basically the taxpayers lacked necessary ownership of stolen property to take the 165C3 deduction or to qualify for the safe harbor under the Bernie Madoff, rulings from back in 2009. Next up, we have another public tax court decision. This one was a divided decision, right? What was it as? A divided tax court. So it was not unanimous. But this is the scope of Section 172B3 carryback waivers. It's Apache Corporation and subsidiary versus the IRS commissioner. This is 165 TC number 11, issued this year. Now, Apache incurred significant net operating losses in 2016 and 2017, a portion of which qualified as specified liability losses. They were environmental contamination liabilities. And under the rules, specified liability losses can be carried back 10 years. But for that year, other losses can only go back 2. So because general losses had a 2-year carryback, and SLs have that 10-year carryback period, what they wanted to do was go ahead and carry back specified liability losses for 10 years because that gives you a lot of years to recover them. And they had, basically higher tax rates then. So they're all for that. But they didn't want to carry back, for whatever reason, the rest of their loss, which only go back 2 years. They filed election, under Section 172B3 to waive the entire general carryback, but explicitly stated it retained the specified liability loss 10-year carryback. Now, the IRS said no. If you elect under 172B3, you elect to waive the carryback, that is an all or nothing election. So you relinquish the entire consolidated NOL, including the specified liability loss portion, when you attach the election out to your return. Now, as I say, this is a somewhat divided decision. The majority is going to say you can divide those two elections. Another part of the, that concurred is going to say, no, you can't. But this was an improper election because they tried to divide it. So therefore, the 10-year carryback worked, and that's what the IRS is trying to deny, that refund. So, basically the IRS came after them, to try to get back the 10-year carryback refund. They're saying, well, there was no election, meaning they'd get to carry it back 10 years for that. IRS, you're attacking the wrong thing. You should have attacked the question of, the loss that would disappear because they hadn't carried it back, which still is kind of a problem if they haven't been able to use it yet. But if they have been able to use it and the years have closed, so it's 2016, 2017, so they would have made their elections then for 2017 return. If let's say they were able to use that up in 2018, 2019, 2020, and 21 is still, 21 should be closed by now. So we're probably okay there too. So we're 4 years in. Well, yeah. Let's see. Yeah, the 21 return to be closed. That's right, because we filed that return in 22. Therefore, 25, we're good. So if they'd used up the carry forward, then the IRS just went the wrong way, unless they had also, somehow preserved the statute for those other years, which is unlikely. I think they got too focused on, well, you can't do that, and didn't really think through, if you can't do that and you try to, what's the impact? So a couple of them do that. And I believe there was one judge that just totally disagreed and said, nope, the election did bind them entirely. It was okay election, and therefore they couldn't do the carryback. So what happened in this case was, the statutory language of 172b3 permits the taxpayer to relinquish the entire carryback period if entitled to a carryback period under paragraph 1. Because 172b1 establishes multiple carryback periods of different lengths for specific loss categories. A general one, a specified liability loss one, a farming loss one. And Section 172F5 mandates that specified liability losses shall be treated as a separate net operating loss for carryback sequencing. Now, this gets into what exactly does it mean, the entire carryback period? If it's entitled to a carryback period under paragraph 1, when paragraph 1 lists 3 separate carryback periods. The tax court found that was clear, which I do admit, there was some of the complaints from the other judges was simply that that's not clear. It can be read two ways. And so we do that. Now, one that said, but we usually interpret taxpayers' favor where it's unclear in a case like that, and therefore he went with them. So we have all kinds of reasoning in this case. But bottom line, the general opinion was that it gives you 3 options, right? It says the entire carryback period merely refers to a carryback period. So in essence, the court holds that you can separately elect to whether to carry back or carry forward, or you can waive the carryback period only for the 2-year, or only for the farm loss, or only for the specified liability loss. You can pick each category. So you basically, for each one, you could say, I will waive the carryback for the regular loss, but I will not waive the farm or the specified liability loss. I'll waive I won't, I'll waive for the regular loss and the specified liability loss, but not for the farm loss. Whatever combination would work, right? And it said, since the specified liability loss is treated as a separate loss carried back for a different duration, the court found it logical that these portions have separate carryback periods to which the waiver election applies individually. So that is the official majority position of the tax court. Now, for precedent on this, the court relied on circuit precedent that recognized specified liability losses as having a distinct longer carryback period than ordinary NOLs. This is Next Era Energy and Barrick Resources. And historical administrative guidance regarding product liability losses, which was the predecessor of specified liability losses, also supported the ability to waive the general carryback without impacting the 10-year period. The court noted that statutory interpretation were a close call. Longstanding precedent requires the complex return statutes be construed most strongly against the government. So therefore, the majority position was that they were legally permitted to relinquish the 2-year carryback while not relinquishing the tenure, that it was all fine. Therefore, they could get the carryback from they get the refund from the 10-year carryback, which they'd gotten, and then keep it, and they could then carry forward the other loss. So essentially, that's their ruling. Now, generally, the way you could imagine this is, let's say an NOL is an annual flow of water. We're going to look at the water here. I'm in the desert, so we're going to think of water, right? Supposed to have rain coming. Supposed to be a lot more rain coming on the West Coast and Los Angeles area in particular. I saw this morning, but we're supposed to have some coming through here this weekend as well. And water flows weird places here once it starts flowing. And that's also. So we got the standard, general NOL portion flows from the standard two-year reservoir, the default carryback period. The specified liability loss is separately designated. It flows to a special, much larger 10-year reservoir. The IRS argued that turning off the water flow from the regular wet reservoir, right, you had to shut both simultaneously. It would be required to do the other. Tax court ruled because that loss is a separate loss using a different period, taxpayer may elect to shut off access only to the 2-year reservoir and therefore preserve the 10-year flow for the specified liability loss. That is, you have two valves, not just one. So again, it was a divided tax court. Whether the IRS decides that that division is big enough and this issue is big enough to warrant going to the Court of Appeals is open. But do remember, until somebody makes a change on this, overrides it, you go to tax court's going to say you can do this right now. So it'd be up to the IRS to either win another case, get another case and win and get some conflict in play, likely at this point by having to go to Court of Appeals, or hope a taxpayer is suing for a refund, or decide to appeal this one, or just simply say, you know what, this isn't going to come up all that often. We're just going to kind of ignore it here. We'll let it go. So this has been the current federal tax developments for the week of November 17th, 2025. As always, you can email me, edzollers@currentfederaltaxdevelopments.com if you have any quick questions. I also do look in on the Connect sites for Arizona, New Jersey, Minnesota, Illinois, Idaho, and Washington. So any of those states you're a member, go ahead, you can check in. Otherwise, I'm going to hope to see you next week here. We'll be there November 24th. It's a late Thanksgiving this year. So that will be the Monday before Thanksgiving. So we'll have that at that point. That one should come out with no problem. The next one could get more interesting. We'll see how it goes. The good news is I got a short week. The bad news is I have to travel at the end of that weekend, and going to be kind of fun traveling on the Sunday of Thanksgiving weekend. I can imagine what the airport's going to be like. So we'll see. I should be able to get the podcast recorded well prior to leaving, in which case then it's no problem. That's the advantage of that weekend is that, we got 4 open days. I got to fly on one of them. And as I always try to do, I'm going to fly early in the day because that gives me the most options in case things break down at the airport and I'm scrambling trying to get into where I'm heading to. So got that done. But anyway, we'll see what comes up. So hopefully we should see you all back here in a week for more current federal tax developments.